Good afternoon, everybody. Good afternoon, and welcome to ActivTrades Monday Market Matters webinar for the 23rd of September 2024. It's Paul here. Great to have you here with us today. Today, we're going to talk about how do traders go about using stop losses. So, interesting subject, a very important subject for all traders, but in particular for new traders at the start of their journey. And so hopefully we'll be able to explain the importance of stop losses and how you go about utilizing them. As always, as I said, great to have you here. Just appreciate for those who are joining us for the live session, if you can just confirm the technology is working in our favor, that you can see the slides and that you can hear my voice, that would be fabulous. It's always good to know that. Excellent. That's great. Thank you very much. All right, I appreciate that. Thank you. Okay, so here we are, Monday Market Matters. So we'll have a little look at the news that's gone from last week, because it was such a big week, and that we have coming down the pipe for the week ahead of us. But we're going to talk about an introduction to risk management, why do traders use stop losses, and what are the types of stop losses that you can utilize in your own trading. So plenty of that, and plenty that hopefully you'll be able to take away and utilize in your own trading from today's session. It would be interesting to know, of those of you joining us here today, how many of you are currently aware of and currently use stop losses in your own trading. If you could just sort of confirm that in the chat box, that would be appreciative. And as always, there's if you have questions or comments, you're very welcome to put them in the chat box. So we're always happy to take them on board. Okay, so Kesta says, yeah, I'm using stop losses. V says, yes, I'm using them as well. Okay, that's good. Okay, that's a good start. Because, I do appreciate that, for our sessions here, we have, whilst these are the English-speaking sessions, we have a truly global audience. Okay, people join us from all over the world. You're all very welcome. It's great to see you here. But I also recognise that we also have a broad spectrum of people's experience, to people who've traded for many years and are very experienced, to those of you who are just at the start of your trading journey. And particularly today's session will be incredibly important for those at the start of their journey. And I'm hoping that for those of you who have experience as trading, what it will do is it'll act as a nice recap, just reconfirming best practice in trading, and that's what we'll be looking at. Okay. Martin says, "Yep, I use stop losses to protect profits deep in the money." Okay, excellent. That's great. William says, "Yep, I'm aware and I'm using them." Fabulous. Okay, that's great. Okay, that's good to know. That's good practice. Okay, and I'll show and we'll talk about it a little bit deeper into the session, why that is relative. Why it's relatively important for all traders to understand and grasp these concepts right at the beginning of your trading journey. For those of you who don't know me, my name's Paul. Traded for many years, traded for funds, traded for clients. Primarily, I focus on trading FX indices and commodities. That's where I like to operate, and I tend to be a trends trader for longer term swing and position trades, and I tend to be a mean reversion or a reversal trader for sort of shorter term intraday trading. Regardless of your style of trading, okay, whether you're a scalper or whether you're an investor or whether you're a position trader, okay, well, regardless of what instruments or asset classes, it is crucially important for you to understand risk management and stop losses. Okay, it doesn't really matter, as I say, how you operate. Having a grasp of it is unbelievably important. For those of you joining us for the first time, so today is part of ActivTrade's regular webinar series called Monday Market Matters, and the whole idea is to help you start the week in the right frame as we prepare for the opening of the US markets in about 25 minutes time. So every Monday, 2 o'clock London time, we'll take a look at the news that's coming down and sort of the pipe for us this week. Have a major element on education, which is today about stop losses. We'll always have a little chat about the ActivTrades platforms and tools that you have available to you as a client, and then we finish with a look at the live markets as we enter that US session. So there's always plenty for us to cover, always plenty for us to discuss. As I say, if you've got comments or opinion or questions, you can put them into the chat box. We always welcome them. It's always good to hear other traders' comments and thoughts. And as I say, I appreciate for some people they're at the start of their trading journey, and so the opportunity to ask some questions is valuable. That's what we're here for. Okay, so without further ado, let's have a little look and a chat about the news. I say the same every week, and I make no apology for it, that if you are at the start of your trading journey, I don't expect you to be able to analyse the economic news, but it is important for you to know when that economic news is coming out, okay? And you can find that data out on an economic calendar. There is an economic calendar on the ActivTrades website that you can access, and there are other ones on the internet as well. So there's no excuse not to know when the big formal economic news is coming out, because that big formal economic news is likely to induce volatility into the market. And volatility, as an experienced trader, volatility, I always say, is a double-edged sword. When you're on the right side of it, it's fabulous. When you're on the wrong side of it, it can make trading challenging. So it's important to know when that data is coming out. Last week, as if those of you who join us every week, remember I was talking about how last week was going to be a major week in terms of both the volume and also the quality of the news, and that's what we had. And probably the big news was the Americans at the FOMC meeting, where the Federal Reserve, Mr. Powell, cut American interest rates by 0.5%, which even I, I was caught a little offside by that. Whilst we talked about it last week that we're likely to be cut. I think most people thought that it would be about 0.25% interest rate, but it was rare for them to go with both barrels, for want of a better word, in the interest rate. But of course, that has then knock-on impact into markets, which we saw Thursday, Friday, and which I think we will probably see this week, because not only is the aftermath of that big major decision, but what we will also have, there are quite a few of the American members of the Federal Reserve speaking today and throughout this week, and then invariably traders will want to sort of see what their comments are about the trajectory for the Federal Reserve for the remainder of this year. So big news, a lot's happening, and then there's a fair bit coming out this week as well. Certainly already today. Normally we don't really get major news on a Monday, sometimes, but not always. But certainly today, what we had in the UK, in UK and Europe, was a lot of the PMI numbers, and they'll be coming out later this afternoon for the Americans at about 2:45 London time. Please amend that to wherever you're joining us from in the world. Interestingly, for traders who are new, for traders who are at the start of the journey, understanding PMI, Purchasing Managers Index numbers, it's a good starting point in terms of understanding economic data. And the reason I say that is because it is quite easy to interpret. The PMI number, you'll normally have three numbers. You'll have a manufacturing, you'll have a services, and then you'll have the composite of the both of them. All those numbers are, they will come out between 0 to 100. And the reason it makes it easy for a new trader to sort of understand is that any number above 50 is a sign that that part of the economy is growing. Any number beneath 50 is a sign that that part of the economy is contracting, it's slowing down. And so that gives you a very, very quick snapshot of the health of that economy. Now, admittedly, it's lagging data, but it is still a useful snapshot of the health of that economy. And certainly today, for example, here in the UK, the numbers in the UK were slightly lower than was expected, which is not ideal. However, the numbers were still above 50, so that it means the economy is still contracting. Whereas the numbers in the French and German economy, they were lower than expected and lower than 50, which are signs that the French and the German economy are contracting. So, of course, how is that useful to us? Well, that weighed upon the euro this morning. So we saw euro selling off across the board because of that reflection. So it shows you how it is important to grow to understand these numbers and to start to be able to recognize the impact that they have upon certain assets and instruments that many of you will trade. So we have that today. Tonight, going into tomorrow, we have the Australian Royal Bank of Australia, their interest rate decisions. Most people, there's not really anybody expecting changes there, tomorrow, but people will be interested to hear what they have to say, about their take on the strength or weakness of the Australian economy. And then there's also more economic data from Australia on Wednesday when they have their CPI, their inflation indicator as well. Then on Thursday, okay, what we have is we've got data from the Swiss. So we have the Swiss policy rate there, and people are going to be kind of interested to see, will there be a change there from the Swiss National Bank? So people will be keenly watching that. And we also have the US GDP numbers, okay, and unemployment numbers. And Mr. Powell is speaking as well, okay. So, the Thursday will be an interesting day. Lots going on there. Then on Friday we have we've got the Canadians have their GDP rate, and also the US has their gross PCE number. And that PCE number is a personal consumer expenditure. Is the number that the Mr. Powell and the Federal Reserve make their decisions. That's what they base their decisions in terms of interest rate trajectory and journey. They primarily use the PCE as their main indicator. So it's important to know what that number is coming out, because we know how that influences decisions made by Mr. Powell and the Federal Reserve. So plenty coming out. Always make sure when the news is coming out, and as I said, make sure that you at the start of every week, start of every day, I'd say just even the start of every session, that you make sure and you double check what news is coming out, so that you're aware of that of the risk factor that comes out with that. Okay, so as I said, plenty there to say about the news, but let's talk about traders using stop losses and why they do that. And I suppose to begin with, we just need to have a little chat about risk management in general, and about how traders understand it and how they utilize it, and my view as well about risk overall. My view would be that as a trader, okay, it is your job to take risk, to actually embrace risk. Engaging with financial markets is about taking risk. Therefore, it is your job as a trader to manage risk. And what you will find is that the better you become at managing risk, the quicker your progression will be to successful trader. In many ways, you are not. In many ways, you're not a trader. In many ways, you are a professional risk manager first and foremost. That's a message I've always tried to get across. You have to manage risk first and foremost. That is crucially important. And the quicker you embrace that, and the quicker you understand that, the better your journey will be as a trader. I cannot stress it enough that it's your job to manage risk, and the better you become at managing risk, the quicker your progression will be. So, what are we going to cover here? Okay, what are we going to talk about here to start with, and then also as part of our overall today's session? Well, let's talk about having a little bit of a quick definition of risk and money management that's clear, and then we'll talk about two major rules that I try to sort of ensure that traders embrace and take on board. And then we'll talk about use of stop losses and about position sizing your capital and why those are important. So I'm a great believer in keeping, in the old KISS definition of keep it simple, stupid. Risk management, as it says, it involves essentially how much you're willing to risk and how much you're looking to get. And that's a very simplistic definition, but we could even break that down into further, whereby some people might see risk management as the management of open trading positions to avoid large losses occurring, and money management is about setting correct position sizes in relation to your overall portfolio and your overall cash position. But it is at its crucial core, it is involved knowing about how much you're willing to risk, how much you're looking to gain, and management of those positions to ensure that you avoid large losses. Now, as I said a couple of slides ago, the better you become at that, the swifter your progression will be as a trader. Lots of, let's say, people coming to the start of their trading journey maybe don't understand it, don't truly embrace it, and unfortunately they learn the hard way. Whereas here you have the opportunity during these sessions to be educated and to learn and to understand that they really are crucially important to your journey as a trader. And if you don't believe me, well, you can believe Mr. Soros. I appreciate that sometimes Mr. Soros can be seen as a controversial figure, okay, in terms of his views on the world. But ultimately, he was a very, very successful hedge fund manager. And, this quote of his is, unbelievably important to embrace and take on board as a trader. As he says, my principle is to survive first and make money afterwards. All right, lots of people have it the wrong way round there. But as I keep stressing, your job as a trader is to be a very good risk manager. That's what we're looking for to begin with, okay? So how do you actually do that? What does it actually mean? Well, how does it, how do you build that into the way you operate? Well, what I try to get across to traders is two very simple rules, okay? Two very, very simple rules. And rule one is you always live to fight another day wherever possible. That's important. Now, I've got a photo up there. That's actually from an air-to-air dogfight from many, many years ago in my previous job from another lifetime apart. But even that, okay, and in air-to-air dogfighting, etc., in battle management, your rule number one is to live to fight another day wherever possible. And it's the same way as a job as a trader and investor. Your job is to live to fight another day. You will have days where you're on the wrong side of the market. Everybody does, okay? It is part of your experience being a trader or an investor. That's fine, okay? The important thing is that you live to fight another day, all right? That's, if you've had a bad day, if you've been on the wrong side, okay, that's absolutely fine. That as long as you're in a position to live to fight another day, so that you can debrief what you did, learn from it, and then become a better trader every next day. And in many ways, that's part of your journey as a trader, is just being a better trader tomorrow than you were yesterday, and that just general progression through your overall journey. Well, one of the ways you do that is to make sure that you always follow rule number two, okay? And that is never, ever find yourself in a trade without an exit plan, okay? I'm sure some of you will have watched movies like James Bond movies, and he never goes into a room without knowing what his exit plan is, where he's going to get out of that room. And that's the same for traders, okay? You never, ever find yourself in a trade without an exit plan. And ideally, that exit plan should be identified before the trade is even placed, right? Before the trade is even placed, okay? But most definitely by the time the trade is open, you have to know where your exit plan is, okay? It is unbelievably important. And so if you follow those two rules, rule one, rule two, okay, you start to sort of find yourself doing the right things. And then you look at, well, okay, how do I turn that into a couple of rules or a couple of habits and behaviors that I can follow that will help me be a better trader every single day of my, of my trading career? So when we break that down into what we actually do, okay, regardless of what instruments you trade, regardless of what time frame you trade, regardless of the vehicle you engage with markets, maybe spread betting or an FX account or CFD account, it doesn't matter, okay? You always follow two simple rules. Always follow two simple rules with your trading. One, never risk more than 1% of your overall capital on any trade. And two, never ever trade without a stop loss in place. If you do those two rules, okay, if you do those two habits, those two behaviors, well, then that will always ensure that you basically make sure you are fulfilling rule number one, which is to live to fight another day. So that even if you have a bad day, okay, even if you have a challenging day, you have lived to fight another day, which means you've managed to maintain rule number one. So you never risk more than 1% on any trade, and you never ever trade without a stop loss. And if you take nothing but those two lines, okay, from all of the sessions that we do here, okay, then that will help you progress forward as a trader, okay? Never risk more than a small portion of your capital on the trade. Never ever trade without a stop loss. They almost have to be kind of subconscious, okay? The sort of the actions that you take. So of course today we're going to focus on stop losses, all right? We will focus on position sizing in a separate session, but today is going to focus on stop losses, what they are, how you place them, what do they do, why do you need them, etc., and also different types of stop losses that you can consider and take on board. as I said, I appreciate that for some people, they're at the complete beginning of their trading journey, okay, and they might not even know, well, what is a stop loss, Paul? What does that actually even mean? Well, at its most basic, simple form, it's an order to sell an instrument, okay, well, at a specified price in order to limit a loss. So many people, this is just a chart, okay, just a standard chart, nice bullish uptrend, okay. Many people, let's say, for example, we're looking to buy when prices pull back and when price reignites, okay, in the existing trend, they're looking to in this case, particularly buy into that market, okay, and they will happily focus on that. But what we want is, as it says, is also another order, a stop loss, okay, stop loss that ensures that basically, should price not follow in our plan, should price roll over and actually sort of collapse, well, then basically we are taken out of the market in order to limit our losses, okay, in order to limit our losses. Remember, we want to live to fight another day. That's what we want to do. We want to be professional risk managers first and foremost. So let's have a little look at that and what that actually means and what it particularly looks like. When it comes to basically considering and talking about protective stop loss, these are important words, okay? It is about protecting yourself at all times and in every trade, okay? This is not something that you just do on the odd occasional trade that you feel like it. It needs to become a subconscious habit that you follow day in, day out of every day of your trading career. You protect yourself at all times. And if you take a loss, don't take it personally, okay? You don't take it personally. It is part of trading, okay? It is part of your journey. However, trading without a protective stop loss order, well, that's exposure to self-destruction, okay? And that's not what we're here for, okay? We're here to be professional risk managers and successful long-term speculators in financial markets. So to do that, you have to make sure that you protect yourself with stop loss orders. And a stop loss order is an order we place at the time of entry, okay? At the time of entry, not hours later, okay? But at the time of entry to take us out of the market when we know our idea has failed. And that's what it's about, okay? You might have a fantastic idea, but the market may have a very different idea about where it wants to go. And if you do not, okay, have a stop loss, well, then you open yourself up to taking larger losses than you need to take. And remember, rule number one, live to fight another day. It's all right, live to fight another day. When you take a losing trade, that's fine. It says nothing about you as a trader. It says nothing about you as a human being or about your self-worth. You are operating in a dynamic environment, okay? A dynamic environment which changes all the time. Being wrong, okay, is absolutely fine. It's part of it. But staying wrong, that is where the challenge is. So what we do have is there are actually multiple types of stop losses, multiple types that you can do, and we'll just talk briefly through a few of them as we go through our session here today. So what we will see here, just bring up the thing, there are lots of here protective stop losses that you will hear traders talk about, things like technical analysis stops, financial stops, okay, where basically it might just be decided on a kind of the amount of money that a trader is prepared to lose, but that might not necessarily be the smartest way to operate. You'll hear sometimes people might use discretionary stops, okay, as in they might not place a stop on, but they will just get themselves out of a position when they feel that it's not going for them. I say that's not a terribly smart way of operating. Some people might have psychological stops, namely once the position starts to cause them psychological pain, that they leave the trade. Once again, I don't think that is a smart or effective way to operate. Volatility stops can be based upon the underlying volatility in the instrument, and that can be a useful way, okay, to basically have a stop loss if you're unsure where to place it, and we'll look at an idea for that. You can have a percent stop, namely, if the instrument, okay, drops back by maybe 5%, 10%, 20% from its highs, that you look to exit the position. I personally don't think that's ideal for trading. Some investors might like to operate like that. It's better than no stop, but it is not an ideal stop. And some people might have time-based stops as well, and I do myself, certainly on some of my intraday trading, namely that if the trade has not played out how I planned it within a set period of time, well, then I look to close the position regardless. And part of that is not about protecting financial capital, though it's also about protecting emotional capital. When you're sat there watching a trade just do nothing, okay, and go sideways, that doesn't really help you either. So for today, we're just going to focus mostly on technical analysis stops, but I'll also have a little chat about volatility stops as well. So I just listed lots of them because if you're new to trading, you'll hear lots of people talking about lots of different protective stop losses. But the important thing is that you're using you're using one, B, you're using the right one as well. That becomes important to us as traders as well. So a very simple example of, a technical analysis stop loss is one that people utilize if they're trading pin bars. Okay, maybe it's a pin bar, maybe it's called a high test or a low test, maybe it's called a hammer, right? Maybe some people might consider it as a rejection candle. Okay, but it's the important thing is it's just a very simple. It's a very simple way to use a stop loss and a very simple setup that lots of people use. If there is a pullback, the price prints this, I would call this a pin bar. Okay, what we're always looking to do is we are looking at the trade for price to pull back before it carries on. Okay, price never moves in a straight line. You've heard me say that before. Price generally tends to zigzag to its destination, and what we're looking to do is to try and buy that pullback. Okay. And if that pullback is ended by something like a very nice pin bar, okay, well, then that's even better. We've got confluence of events. But what we're looking for is we know where our entry is, okay, when price breaks above the high there, that looks to take us in. But what we want to do is we want to protect ourselves with our stop loss. We have our stop loss, a few points beneath the low of the candle. Okay, now how many points that could be will depend upon the time frame. Okay, it might be different if you're trading a 5-minute chart regarding a daily chart. Okay, so you need to amend accordingly. But it should just be a very, very simple technical analysis pin bar stop loss should be just beneath the low of the candle by a few points. And what that means is that you're now protected. Why do you need to be protected? Well, this might look like a beautiful setup, and it's possible that you can be triggered in, but then something happens, something happens in the world, and invariably the instrument price collapses and drops. And what we want to do is we want to be taken out. Okay, we want to stop our losses, because what we don't want to do is we don't want to blow up all of our equity. Remember rule 1, live to fight another day. That's what we're always looking to achieve. And a stop loss, okay, a stop loss helps us do that. If price trades below our stop loss, we no longer want to be in trade. Our idea has failed on that occasion, and that's okay, right? That's okay. That is good risk management. You've identified your trade, okay, you planned your trade your plan, manage your risk. It's one of the 3 things that you are in control of with your trading, so it's important for you to take on board and operate with. It is important even on something like, here's something a bit different, okay, daily chart of the Dow, whereby when price is in pullbacks, okay, it becomes very clear if you're buying, nice bullish candles in a pullback here, okay, that it provides you with the opportunity to know exactly where you're going to be wrong, and so our stop losses would always be beneath the lows of the candles, okay. Our stop loss is always beneath the lows of the candles. And here, this is a nice uptrend. We're looking happy in my particular case to buy pullbacks and trends, okay. Remember, trade never moves in a straight line, okay, never moves in a straight line. And so, we might be wanting to buy the pullbacks, okay, in an uptrend, but also we want to have our stop loss underneath them, all right, stop loss underneath them to ensure that if the trend changes direction or something occurs, we have managed our position, okay, we are managing our risk, we are ensuring that, rule 1, we live to fight another day, and rule 2, that we have never entered a trade without an exit plan in place. Okay, just simple taking on board these simple rules help you just trade with better peace of mind. So let's have a little chat about various different types of protective stop losses, okay? So as I said, some people will use technical analysis stop losses. I do myself, okay? And so this is an example here. This is an old chart of like a Google on a weekly, and this is, it's putting a price action of a bullish flag. And here we're using lines of support and resistance to give us an idea of where we are wrong. Or you can use fractals to place your stop losses behind. So in this particular case, our entry might well be, breaking of the trend line. Okay, it's a flag pattern, but we need to know, we know where we're getting in. We need to know where we're getting out when we're wrong. And so here you can use either technical analysis like a fractal there, or stop loss beneath there, or if you want a bigger stop loss, you might have it beneath the other side of the flag. Okay, that's okay. Part of it is about understanding your overall temperament for risk. Some people are very embracing of risk. Some people are very averse of risk. It's about understanding, what type of trader you are. Okay, everybody sits on that risk spectrum, and about you have to manage your risk management plans to embrace that and take that aboard. And so there's absolutely nothing wrong in there in invariably utilizing, okay, just simple lines of support and resistance, okay, or a simple indicator there to help you identify where your stop losses can sit. That's absolutely fine, okay, absolutely fine. Some people would use things like a trend line, okay, as a trend line as a stop. So in this particular case, this was, silver. It was in a consistent downtrend for a couple of years, and actually people would, as they were shorting this instrument, they would basically have their stop loss above the trend line. Can you use it? Yes. Is it the best way to use it? I wouldn't necessarily say it's the best technical analysis stop, okay, but it is valid, and it's certainly better than not having a stop. And in this particular case, you can see, let's just clear this down. Let's clear these down. It's that, having done a reversal pattern here, we can see that basically then we created a higher low, and here this is where, if you were basically trailing your stop behind the trend line, that's where you'd have been taken out on your particular short. So it is better than no stop loss, but I don't think it is. I don't think it's ideal. It's not something that I particularly personally use myself, but I know traders who do like to use trend lines as their stop line, and it is valid so long as it is a good trend line. Okay, that's what. And so some people will use that as a variation on a technical analysis stop. One technical analysis-based protective stop loss that is useful for traders, and that actually is helpful, and I would happily see and suggest to traders to use, it is one based upon the average true range. This is the volatility stop, okay? So the ATR indicator is available on all of the ActivTrades platforms, okay, as an indicator, and I'll show you where it is when we switch across to the charts in a short while anyway. And in this particular case, this was an intraday trade. This was actually on the Canadian dollar against the Swiss franc on the 30-minute chart, and we were looking to be short. And what we were able to do is to use the ATR indicator for the stop loss. And so what we did is we used the 2 times, okay, the ATR for the initial stop loss. Now we have the indicator there. It also printed it there. Okay, what it was is 9 pips. So 2 times the ATR would mean that our stop loss is, in this case, 18 pips away from our initial entry. Okay, so it's twice ATR. If the ATR is 9 for the 30-minute chart, well then our stop loss would be, in this case, 2 times ATR. Why would you have it as that? Well, it's the average true range. So we were expecting what, the actual average range of what, that instrument moves in a 30-minute window. By having it 2 times the ATR, it means that the likelihood of your stop being triggered is much more reduced, okay, unless there is some, a major event or a major piece of, news comes out, okay, that people are unaware of. But generally, it is a way, and it is simple, and it's safe. And if at the start of your trading career, you are struggling in terms of, maybe you're struggling in terms of your levels of understanding charts, or being able to analyze charts, well, this is a very simple mechanical way for you to work out where your stop loss can go. And as I said, it's better than not having a stop loss, and it is a simple way. You can just find out what the average true range is, use the ATR indicator, and just as a general rule, use 2 times the ATR for your initial stop loss. So, in this case, we were going short here, okay, when price rolled over, and our stop was, as you can see, our stop was way above the recent highs. It was up here, but also it didn't really come anywhere near it, okay, as price rolled over. And that's what it means. So certainly that kind of volatility by using the indicator, is absolutely fine. And I'm very happy if new traders look to utilize that, because it is also quite mechanical as well. It's quite mechanical, it's quite process driven, and that can be very useful for traders as well. I have also seen over the years where, and this is an example of Brent Weekly, where some traders might just use a significant number as their stop loss. Okay, so this is Brent Weekly, and in this particular case, they were using $50 as a significant number as a stop loss. Here we can see it did come down and touch it here. Once again, it is valid as a way of using stop loss, but it is not something that I would truly recommend. Okay, it's not something that I would truly recommend. And as you can probably see here, that's $50. The price has moved. The price has moved considerably, okay, in and out of that particular number, and so it means that it's whilst it's there and it's valid, it is not the ideal way to do it. Okay, I would far sooner new traders use something like the volatility indicator. Okay, using the ATR indicator, or just using something like one or two other indicators or trading ideas that we're going to use and talk about in a moment. Okay, so it's there. It's valid, but not something I would recommend or suggest that traders use personally. That would be my personal view. There are better ways to basically use stop losses in your own trading. Another simple way, okay, that you can use an indicator is using an indicator, simple indicator like PSAR, okay, parabolic support and resistance. Why would I suggest this? Well, once again, it's an indicator that is available on all the ActivTrades charts, and it is almost like mechanical, and it does most of the work for you in terms of working out where to place it. So if you're struggling at the start of your career, okay, if you're not really sure, as I said, what your analysis is like, if your analysis is not, skills are still being developed, well, using something like PSAR, can actually be very helpful. It just makes sure that you have it in there. And it is, as you probably might be able to see, what we've got here is there's dots, okay? It prints dots as the indicator, prints dots on your chart. And in this particular case, so if, let's say, for example, we were buying, this is, 4-hour chart of Tesla, Tesla's above its moving averages, we're looking to be a buyer. What we would do is our stop loss would be placed, okay, where the PSAR is, okay, where the PSAR dot prints, and then you basically amend your stop loss, okay, once on the system, to basically follow the PSAR every time it rolls until either the stop loss is triggered, or as you can see in this case, it changes as well, it flips, okay. So when price is an uptrend, okay, the PSAR will be beneath it, and you can use it as your stop loss. Or alternatively, when price is in a downtrend, the PSAR will print above it, okay, and you can use it as a stop loss above. Once again, this is something that, as I said, if you are struggling with your analysis, if you are struggling to put your stop loss in, okay, if you're maybe struggling to follow a simple plan or a simple rule, this is something that can help you, because it is an indicator that is available to you on the ActivTrades platforms, and you can just utilize it, okay, as it is. As soon as it prints, once you're in your position, well, then your stop can go there, and invariably you just follow that stop. You just amend that stop for every time the PSAR prints another dot, until you know the trade is taken out. So once again, it's kind of simple, it's mechanical, and you know you have an indicator there on the chart that you can utilize to help you. And for some traders, that actually can be really helpful. Okay, that can be really helpful for them. Okay, it just makes it mechanical, makes it simple, and takes away any kind of having to think or consider or analyze the way that you can operate. So hopefully I've just shown you there that there are many different types of stop losses that a trader can use, okay, from just using simple technical analysis, stops on price action, okay, behind a bin bar or an engulfing candle, okay, you know, or tweezers or etc. The thing that I have learned over the years with my own stop losses is that there is no perfection, okay, there is no perfection. What is more important is that you have a simple one or a simple concept that you can understand, and that it just confirms that the idea is no longer valid and that it's time for you to exit the trade and step aside from the market. It is better to have a simple stop loss, okay, idea or concept, whether it be 2 times ATR, whether it be using the PSAR indicator, whether it's just, you know, beneath the sort of the fractals, beneath the swing lows, okay, just a simple one that you can understand and that you can work with and you can be consistent with, okay. There is no perfection. You're never gonna find the perfect stop loss, in the same way that you'll never find the perfect target for your trades. Markets are just too big, too dynamic, okay, for that to happen. So just because there's no perfection, though, doesn't mean that, you know, you don't need to use it. Quite the opposite, okay. You need to make sure that you are using a stop loss in every single trade, okay. And, you know, like all of these elements, the more you practice it, the more you work at it, the better you become, the slicker it becomes, okay. It's just, you know, a little bit of deliberate practice in putting that in will help you enormously in where and how to utilize your stop losses. Okay, so just in conclusion, you know, Monday Market Matters webinars is here to support you in your trading during 2024. Every Monday, 2 o'clock London time. We'll always cover the news, some education, ActivTrades tools, and a look at the markets. You've heard me say every week this year, it's going to be an interesting year in the markets. Okay, so I hope you'll join us to enjoy the journey. I think here, as we come towards the start of the final calendar quarter of the year, I think it's going to be a rather riotous few weeks and months ahead. So remember, as a trader, it is your job to take risks. And the better you be at managing risk, the better your trading journey will be. And the way you manage that risk is by only risking a small portion of your capital on any one trade and never ever trading without a stop loss. Those 2 rules: never risk more than a small portion of your account on a trade, never trade without a stop loss. There are multiple types of stop losses, okay? Multiple different types, from technical analysis to percent-based to discretionary, okay, to volatility, etc., etc. None of them are perfect, right? It's important to find the one that works best for you, the one that is just easiest and simplest for you to use, because actually that's what you need to focus on. So, with that in mind, ladies and gentlemen, let us switch across and let's have a little look at what's been going on in the live markets as we start to enter this particular week. Before we do, just a reminder, okay, Monday Market Matters every Monday, 2 o'clock London time. I hope you'll join us next week, 30th of September, where we're going to be talking about what's it like to trade a long squeeze or a short squeeze. Some of you may already know what the squeeze is, some of you may not, and that's what we'll be covering next Monday as part of our educational element, and I hope you'll join us for that. For those of you who want to catch up on previous sessions that you might have missed, you'll find they are on the webinar. Okay, if you look under the webinar tab on the website, you'll find webinar archive. You'll find some of them there. You will also find them on the ActivTrades YouTube channel. So be sure to subscribe to that and follow us, and you'll find all of the previous webinars will be going up there as well. So let's switch across to the ActivTrades platforms and have a look at the markets. As always, if you've got any questions or comments or feedback, or maybe there's topics you'd like to see me cover in future sessions, you can do that you can email englishdesk@activtrades.com, and they'll be very happy to take your comments and thoughts and feedback. So without further ado, let's switch across to the charts. Just bear with me a moment and I'll bring that up and we will have a look. So just bear with me for one moment, please, ladies and gentlemen. So I'm hoping you can see the ActivTrades platform. I'm hoping you can still hear my voice. Let's just get the old drawing tool. This is a profile for the dollar here. Okay, so I have profiles for most of the instruments that I particularly like to focus on. So this one is on the dollar. So I have the dollar index here, Aussie dollar, Kiwi dollar, Euro dollar, dollar CAD, pound dollar, dollar yen, dollar Swiss francs, pretty much all of the majors against the US dollar. That gives me a great take on the on what the dollar's doing and whether it's strong or weak. Let's have a little look at the price action here, okay, on the dollar. This is the weekly chart of the dollar, and you can see for yourself, and we've talked about it the last few weeks, how price just really drifted its way down there, didn't it? Really drifted. We wrote great strong downtrend, and now what's happening here, we're sat on the big 100 number here. The dollar index sat above the weekly 200 period moving average, and price is just deciding what it wants to do. Of course, with the interest rate cuts generally tend to be poor for the nation's currency. And that's what we've seen there. If I go down to the daily chart, though, this is the daily chart. Let's get the drawing to what we have seen. What we've been operating on is we've had a downtrend, okay, throughout August, and we put in a bit of a base there at 100, and then it started to look like maybe we're getting a double bottom there, okay, with the second leg being a nice bullish pin bar. But we needed to break on 0.2, okay, this fractal here, for it to convince us that we were going up. But as you can see, it couldn't, and actually it didn't. And then what it did is it raced back down to 100. And so, now we're looking like we've got a bit of a sort of triple bottom building there. Price is a bit tucked between the kind of the 20 period moving average and also the big round number of 100. You can see there. What I suspect we'll see is that as we have some of those members of the Fed, as they sort of do their speeches throughout the week, that might be what brings the volatility. But let's clear this. Let's clear that. I'm still sort of thinking that if I was to confirm that we're going to see dollar strength, well, I'd need to see it above that level there, where it's been boxed in. I need to see it above there and probably above this 50 as well to confirm it. Alternatively, on the short side, if it breaks south of 100 and continues down, that in itself is just more bearishness for the dollar. So that helps me build a plan of what I'm looking to see, so that I'm in a position to work. So for me, based on what we've just talked there, if let's say this week price decides to break and move further south, well, if I was shorting the market, my stop would likely be here. Okay, this is the fractal here. That's the fractal. Okay, and I'd know that would be where my stop loss would be. Remember, if you want to know where you can find fractals, just let me bring it up here. Insert indicators, Bill Williams fractals. There you go. You can find that MT5, MT4. Okay. Also on things like TradingView and other platforms, you'll find it there. But if, as I said, if price was to go south, okay, if price was to if the dollars continue down, that's where I'll be looking for my stop. But equally, if price, let's say, if price was to break out, well, then to be fair, this is that would be the last low fractal, the last low swing point, and my stop loss, if I was long, my stop loss would probably be there unless there's a change in the price action here over the next couple of days. That's what I'll be watching out. So it is important that when you're looking at charts, not surprisingly, you're looking for where could my entry be. But the smart traders are looking at not only where is my entry, but where is my exit. Okay, remember rule number 2, never enter a trade without knowing what your exit plan is. Okay, and you should be doing that at the start, just identifying where you're wrong as a trader. But anyway, dollar sold off. It's going a little bit sideways now. How does that look against the other majors that the dollar trades against? Well, if we look at, let's say, for example, the euro dollar here on the weekly chart, having pushed to new highs, we fell back to 110. big round number. Okay, printed a nice bullish pin bar, and then last week we rallied our way up. Now we're falling today. Remember what I was saying earlier is that those kind of PMI numbers for France and Germany went great, and so hence why we saw weakness in the euro. But you can see that from last week, we just rallied up there. Okay, there's euro strength, but then today, if you look at, you can see here this morning there was the big drop there, the big drop in euros because of those French and German PMI numbers. Okay, and that starts to become kind of important to people. That starts to become they can see that, take that as an indication of what's going on in the market, and giving you a snapshot of where that strength and weakness is. And what we have seen is sterling strength against the dollar. You can see here, okay. There you go. You can see here, okay, having reversed here, we have just basically been in that uptrend. Okay, uptrend. Remember, what we're looking to do is, we're looking to sort of buy on, pullbacks. And remember what we're saying, buying on pullbacks, where would my stop be? Well, if I'm looking to be long here, well, my stop is beneath my low. Here, there's a pin bar. I'm looking to buy. My stop loss would beneath the low, which just so happens to also be a big round number, 130. That's a nice to have. It's a desirable. It's not a necessity. But you can see, I know, let's clear this now. In this particular, I know where I'm getting in, the break of the pin bar in the high direction, but I also know I'm getting out where I'm wrong. Okay, I know where I'm going to be wrong. That's beneath this low, and that is where my stop loss would be. Okay, if I was trading with some weekly charts. Now, as I said, admittedly, this is weekly charts, but the price action, that could be a 5-minute chart, could be a 1-hour chart, could be a daily chart, could be a weekly chart, could be a monthly chart. That's what we're particularly just looking at, taking on board, and recognizing and understanding that's that there are as well as identifying the trend and wanting to trade with the trend, we also want to be able to identify where's my exit plan. All right, where is my exit plan? That's what we're always interested in and looking at. Okay, so hope that helps there. Right, now let's have a look. Why don't we have a little look just at the American markets as they're opening here? Just bear with me 1 second, and we'll just bring them up. I just wanted to have a quick look at the dollar, just because it's been such an eventful last few days. So, as I said, if you've got comments or questions or feedback, you can put that in the chat box. Okay, people will pick up on that and stuff. So here we go. So Bush, is the Dow. I'm just going to get ready for the session. Let's just see what how it's playing out. Bang, we're looking for here. Let me just change that. Just change these. Just make it a little bit clearer for people to be able to see. Okay, yeah, so just identify kind of highs and lows of the day and stuff, and then here we go into let's just tighten up these drawings here. Just looking at what the kind of big moves there at the start of the session. This is the Dow, okay, and I'm just going to go down into looking at its operating. Yeah, okay, so. So we can see that when we opened, we dropped again. We really had a big swing up to the high, which was the high of the day so far. If I just look out, okay, the high of the day so far. Okay, it just basically bust that, and then we've just rolled our way back in there, haven't we? Just rolled our way back in. So invariably, if we had been shorting here, as a mean reverse trade, my stop would have been above the highs, and what I'd be looking for here is just looking here, see how at the moment price is pushing down, but there is clearly support there on that kind of that low there. If price pops up, that would be an ideal place. It might become a buy if price reverses. Well, then that would be my stops would be beneath these lows. But what we will be looking at is just looking to see if this downtrend continues. We just need to watch. This is the 1 minute chart. While it decides on that, let's have a little look at the S&P 500. The reason we're interested in S&P 500 weekly chart, we closed at new highs last week, okay, after the interest rate cut. So we're interested to see, well, actually, how's the price going to respond today? What's going to be going on? We've got the CPI, the PMI, US PMI data coming out, or has just come out and stuff about 5-10 minutes ago. How are markets reacting to that? Let's just see how the market reacted on the open. It's actually a subdued open, relatively. Okay, and let's go down. Let's go down to time frames to see how it's operating. Okay, so just here's this is where we've opened it. As you can see, this first half hour on the SP is just very mixed, isn't it? That's very choppy. Okay. As an example, though, here, just whilst we're here, what it would be a good example is this is blue line is yesterday's high. For those people who are like scalping or trading, once price had come up to this range here, it then prints a bearish key reversal. Okay, price pushed to a new high, but closes beneath the low, the previous candle, and then we can see the price shorts its way from there down to 200. So if that would have been normally that would have been as my scalping version, I would have been very happy with that particular type of trade. And what I'd have been doing is, whilst getting short here, my stop loss would have been above the high of that candle. Okay, so that in this case, price went down nicely. But if price had gone down, triggered me, and then reversed again, continued higher, well, I would have been taken out there. I would have just minimised my losses. But yeah, looking at this here at the moment, this is quite a messy start, isn't it? There's in terms of the price action there, it's just looking a little bit. Yeah, it's looking a little bit choppy, okay, and that's fine. It wants to do its thing. That's absolutely fine, okay. Simon says, yes, I use stop loss to protect profits, leave money. Paul, really enjoyed this webinar. The art of stop loss is fascination to see from your perspective. I would like to see more webinars about what trading setups you benefit from when in longer term positions. That's fine, Simon. I'll take that on board. Okay, we'll add that into a future session. I appreciate the feedback. Okay, as always, we want these sessions to be really helpful for you. And I said, stop losses, there's no perfection, but find the simple ones that you can utilize and stick with, all right, and because it'll help you manage your risk. So okay, anyway, so S&P's doing its thing. What's Nasdaq doing? Okay, so as you can probably see, they're very similar in terms of their price action so far today. What I'm probably going to be interested in just looking at is just look at that. Let's go and see how what the start, the first 15 minutes was like. Okay, just gosh, we can see, and then 5-minute charts came down to these kind of lows and bounced off it. So remember what I was saying, give the first 15 minutes a miss. First 15 to 20 minutes give a miss, because it can just be chop like this, and trying to actually trade that is very difficult. But we can see from ourselves that having entered today, Nasdaq come down to these lows, we've popped our way up to the sort of kind of the highs of the last few hours. Is that going to continue with that? I don't have any. I don't have particularly any immediate view on that. Okay, I would just be watching that. It's not. If we go into the 5-minute chart, there's lots of. As you can probably see, there's been quite a bit of resistance there. Okay, so far today, I would be wanting to see us get above that and then break out of it to be very bullish. Shall we? To be very bullish, shall we say? What has the Dow? I'm just going back to the Dow. What's the Dow decided to do? Well, on the 1-minute chart, it's only now just broken through that kind of level of support. So I'd be. Unless there's a massive turnaround coming around here, the averages are down, points down. So I'd be looking here. If I was shorting, well, I'd be looking, my stop here would be above. If I was shorting, for example, if I was shorting the sort of, the pullback, looking it down, my stop would probably be above here, okay, above this last fractal, all right? That's where my stop loss would be. So, I know where I'm getting in. I know where I'm getting out from wrong, and then I would have a target based upon the relationship between the exit and the entry, in terms of where I place my target. But it looks like it's moving down there quite nicely. I'll be watching to see if that continues, or whether it snaps back on that. I'll just I think that going into the next first 15 minutes, the next hour could be quite important, quite serious for that. But as you can see, they're all doing their own thing. Okay, S&P's in the middle. Nasdaq has basically taken out both sides and is now bearish. Dow is bearish, and I'd say Dow is probably leading the way there. Okay, ladies and gentlemen, as I say, time flies when you're having fun, and we've come to our end of our time here. Okay, so here we go. I hope you found that useful. I hope that you found that helpful, and it's, as I said, I cannot stress how important it is to understand risk management and to make sure that you never risk more than a small portion of your account trade. And we'll look at position sizing in a future session, but that you never ever trade without stop loss, and you find a very useful, simple way to do it. So Martin says, good stuff, very helpful. That's great. Kester says, thank you. It's great. Yeah, thank you. You're very welcome. V says, there was a great film, Dumb Money 2023, about short squeezes gone wrong for Wall Street. True story, GameStop. Yep, that's fantastic. I might well be using some of those as examples in next week's session, V, so I hope you'll join us for that. Anyway, I hope you all have a fabulous trading week. Okay, I hope you take on board what we talked about here today in terms of risk management, stop losses. I wish you the best of success in your own trading, ladies and gentlemen. And I look forward to speaking to you next Monday, 2 o'clock London time. Have a great week. Speak to you then. Cheers.